Hi, it's Dre Griggs of Obsidian Wisdom. Today we discuss common myths and misconceptions about dividend investing. So we have made it to the fifth and final video in our dividend investing series. I hope you've enjoyed the videos. We're going to end with common myths and misconceptions, things that I've been asked or even things I've heard people say as if they were true. And for the most part, you're going to find that there is risk in almost every decision that we make, that every financial decision, every financial instrument has pros and cons. And when we normally put things together, we have to put it together in a way that limits and maximizes each of the benefits of every investment strategy. I'll give you a quick example. If I wanted to invest for longevity, then I might look for a company that has a pension. But because of the way pensions are currently designed, where they're not as sexy as the pensions of old, we find that they don't have a COLA, a cost of living adjustment like they used to. So if you have a pension that's going to pay you $2,000 a month, but it doesn't adjust with inflation, that means that that $2,000 isn't going to be worth as much in the future. For example, if you were someone who was going to buy a car, you would not be surprised to pay maybe $500 a month for a car. Like that would not surprise you. And that if you find one that's in the 300 range, that is probably a 7-year term so that they can adjust the payment. Well, why is that? There was a point in time that that would be someone's mortgage payment because of inflation. As the cost of things go up, as the value of things go up, well, now your car payment is what someone's mortgage payment used to be. And that's going to happen in the future. Your current mortgage payment, as crazy as it sounds, is going to be someone's car payment in the future. That's what inflation does. So that ultimately means that if you want to maintain your exact lifestyle right now, then we have to be investing in things that grow our money. Okay, well, if I'm going to grow my money, then I would be investing in equities in the stock market. But what's the trade-off? Well, if I have the ability to make more, oftentimes I have the ability to lose more. So then for me to mitigate the fact that the equities in the stock market could lose money, even though I could grow it, that I might invest in bonds. So now bonds, whether it's government bonds like government debt or company bonds because they're growing and they want to expand, or municipal bonds because I want to be able to help my city and their projects out. Well, now I have the ability to have something that doesn't really grow. It's kind of safe and stable. But if I mix it with my equities that does grow, but is not as stable, but if I mix it with my pension, which gives me a long-term stable income, if I put all of them together, I probably have a relatively good portfolio that minimizes risk in a variety of different situations and probably achieves most of my goals. But if I had any one of them, the risk that I'm dealing with would make it very difficult for me to deal with all of the complexities of retirement planning. And so when you look at dividend investing, it's sort of the same thing. It's not something that you're going to just do one thing and be like, all right, I'm good to go. It probably is something we have to mix and ebb and flow with a variety of different strategies and approaches. And normally I call that wisdom weaving. And it's the idea that I'm able to fashion for myself some sort of a retirement lifestyle that brings me satisfaction, fulfillment, and joy, but also deals with the real risk of financial stress and financial concerns of running out of money. That I want to address all of these in a way that helps me sleep at night, where I know I'm not going to run out of money and affords my lifestyle so that I'm enjoying myself and feel fulfilled in retirement. So when we bring that back and we go through these common myths, keep in mind that there is risk in every investment choice that you have. So our first myth is, are dividends guaranteed? And while I wish that they were, most things that are guaranteed are going to offer us a much lower return. And the reason that is because whoever keeps the risk gets the reward. And so if you were someone who wanted to be a lawyer, would you make more opening your own practice or being a public defender? Now, you and I would say, of course, opening your own practice, but the reality is you might not get anything for opening your own practice. You technically might make more as a public defender for the first 3 years of having your own practice. But because of the fact that you were willing to take that risk and open your own practice, sure, in 10 years, you will probably well outpace someone who's in the public defender's office. But you have the risk as the business owner, and they don't have that same level of risk. The same thing with a doctor. If I wanted to go work in the ER of a hospital, sure, I'll probably make a couple $100,000 a year. But if I open my own practice, I'm taking the risk. So I would have the chance to make millions of dollars a year with my own practice, but I also have the chance to make $0 or just losing money because I still have to pay to keep the business open. Where we often see that whoever has the risk they're the ones that get the most return. And whoever doesn't have the risk or who has a guaranteed return, most of the time the number is much smaller because the person who's taking the risk has to manage you as the risk. I'm going to pay you no matter what happens. So that means I would say, all right, well, if the average return is 10% in the stock market, then I'm going to guarantee you 2%. Because even on my bad year where the stock market loses 30%, I'm able to mitigate that risk because I'm only promising a 2% even on the down year, but I'm getting an average of 10% the rest of the time. And so when you ask the question, dividends guaranteed, we're basically saying no, because there's a board of directors who sit and make the decision for the company. And because they're the ones that are dealing with the risk of the company existing, if they don't have the ability to comfortably pay a dividend, they won't, because they have to keep the doors open. Now, you and I, as silent partners in these businesses, receiving the dividend, resharing in the profits that we've invested in that company for, we get to decide whether we want to stay with that company. We know that GE, General Electric, they cut their dividend during times of economic difficulties. We know that companies like Procter & Gamble continue paying their dividends during times of economic difficulty. Are we just deciding whether we want to invest in the company based on the dividend? Then we know as soon as they stop paying, we're not going to. And if they keep paying, we're going to keep investing in them. But of course, that's just one piece of the puzzle. But it is important to recognize that it is not a guaranteed resource for you, that it is voted on and decided on a regular basis. And yes, while many companies like the idea of being a dividend aristocrat, dividend king, where they pay dividends for 25 or 50 years straight, it doesn't mean that there's never an economic climate where they will say, we're not paying dividends this year. It just means that they really, really, really don't want to. Because how cool is that to say you've done something 50 years in a row? Heck, we're getting ready to watch the Super Bowl and we've seen the Kansas City Chiefs. They're about to have a chance to win 3 in a row. It doesn't mean that I just did it once or even twice, which is phenomenal, but the chance to do something 3 times, that there's a level of luck, a level of consistency, a level of forecasting, and a level of skill that you're really proud of, that it just speaks volumes about your greatness. And because it does, you don't want to just let that go. You don't want to just reset the clock. So I've seen them where companies will lay off half of their staff to continue paying a dividend, and then they'll hire back a percentage of them later on. It's just something that we do want to be mindful of, but the short answer is no, dividends are not guaranteed. Myth number 2, do I need a lot of money to start dividend investing? The short answer is no, because of this thing called fractional shares, where you're able to find a stock. Let's say that the stock is $100 a share. You could spend $10 and they'll give you 1/10 of a share, fractional share. Generally speaking, I'm not someone who is excited by the idea of fractional shares. I do like the idea of long-term investing. What I would do is I would take whatever amount is promised to my future self for my retirement fund, and I would take that amount out of each check. And then as my portfolio grows, so let's say I said I can do $100 a month. Well, in a year, I'll have $1,200 and I will buy $1,200 worth of shares. And then from there, I would then say, all right, next year, same idea. Another $1,200, I'll buy $1,200 more of shares. Now, if something changes where my income changes, I would encourage you, because what I would do is the disciplined approach would be anytime my income increases, I'm not going to lifestyle creep, which is saying that, all right, I got more money, so I'm going to get a better house, a better car, I'm going to take more trips. I would say, all right, I maintain my current lifestyle. How about I take whatever my raise is, that 3%, 5%, 50%, whatever your raise is, and I move that into my investment fund. So if I got a 3% raise, I'm going to take whatever that 3% of my salary, and I'm going to invest that in my retirement fund because I'm able to maintain my overall lifestyle. Now, I do know, and Dave Ramsey and different ones will say, oh, no, you have to get rid of your debt first. And it's definitely something that I appreciate. And from a behavioral finance perspective, if I am super uncomfortable with my debt, it keeps me up at night and I have nightmares and I'm sweating and it stresses me out a lot, then yeah, I would get rid of the debt immediately. If you're someone who's like, yeah, I mean, debt is debt, I'm not going to use it anymore, I'm comfortable even closing the cards if you ask me to, Dre, then I would say, hey, how about we put a portion towards that, and then we put the rest towards your investments? Because what ends up happening is if you pay off all your debt first, then you're at $0 when you paid off all your debt, which is fine. I mean, your money's going to be able to be allocated much more efficiently going forward. But what if we were able to also build the habit of investing our money, even if it was the smallest amount, where now I have my money that's investing, I can see that portfolio growing, where you see the number that says the majority of Americans don't have access to $1,000 in liquid cash, that you by yourself were able to put $50 from each check, and in 1 year, you have over $1,000 in liquid cash. I think that that is a amazing feeling and accomplishment, knowing how difficult it is for most Americans. So then you get in better habits, you get better results, and you get that good feeling where now you're tying your happiness to being able to invest your money into the future. Now, I would still get rid of some of the debt and I would pay off the debt, but I'm more focused on generating the income. That if we were able to increase the amount of income that you had, well, then you can use your passive income to pay off your debt. How cool would that be? Or you can use your passive income to pay some future debt. But the reality is you can start investing today, whether you want to start with literally with fractional shares, or you want to start by putting the money in an investment account, and then you buy the shares whenever the account achieves a number that gives you the ability to buy a share of a stock. Myth number 3 is, are high dividend stocks always better? And you know, when I put the word always in there, that the answer clearly is no, because nothing is always anything. And so we talk about high dividend stocks. What we're talking about is a high dividend yield. And your dividend yield is you take how much your dividend is and you divide that by the stock price. And a good dividend yield is normally going to be 4% or higher, and that an average dividend yield is about 2%. But as we've mentioned, that your dividend yield, because it's just one metric is rarely enough to be able to make a sound decision. And so I'll give you a quick example to show you the risk of chasing dividends and how you can fall into what's called a dividend trap. So we have company A that offers a 12% dividend yield, while company B offers a 3% dividend yield. And what we're normally going to be saying is, okay, Dre, that means that company A, I have to invest a fourth of the money than company B. And for those that don't know, the dividend yield lets you know how much money you have to have set aside to be able to achieve a certain income. That if I had a 3% yield, then I would need $3.3 million to be able to have $100,000 a year. But if I have a 12% yield, then I only need $833,000 per year to have $100,000 per year. You can see you're like, well, dang, Dre, that is a phenomenal, huge difference. But what you may find out is that company A is struggling financially and then maybe cutting their dividends soon, or that company B has a strong balance sheet, a history of steady dividend growth, and stable earnings, making it a better long-term investment. And we haven't even talked about the dividend payout ratio, where what percentage of my earnings are we paying this dividend? That if the earnings of company B, they're paying at less than 75%, I would feel much better than company A, who has a dividend payout ratio of 100%, which means that all of their dividend is all of their earnings. So how could a company reinvest and grow for the future if it's giving out 100% of its earnings in a dividend? Well, the company that has a dividend payout ratio of 50%, as company B does, well, that means I know that they're giving half out in a dividend, but they have half to reinvest in the company to continue growing it. So really do have to take a step back and look at the full picture, that we don't want to find ourselves in a dividend trap where we're investing in a company that maybe even lasts 5 or 10 years, but we need it to last 30 years for a successful retirement. Myth number 4 is dividend investing only for retirees. And no, of course not. You could be someone who's younger and has a portion of their portfolio that's allocated towards dividends, and you're reinvesting your dividends for compounding growth. That doing that over the long term is very beneficial because we've talked about multiple streams of income. Investment income is one of the streams of income, and investment income is what we commonly refer to as dividend income. So if you have that additional stream of income at a young age, that gives you the chance to grow your money more. You have more money that's coming in that you can then reinvest for your future. That is a great approach. If you're someone who's closer to retirement, a little bit older, well, now when we're investing in our dividends, we're actually taking the money out and we're using it as an income source in our retirement. But you still have the benefits either way. Whether I take the income and spend it because I'm older, or I don't take the income and I reinvest it because I'm younger, dividend investing could still be a part of both of these portfolios. So an example of this would be a young investor. So let's say Jack is 25, he reinvests his dividend from blue chip companies, and by the time he is 50, he's able to generate an additional $30,000 per year in passive income, helping him retire early. Or you have Sarah, who's a 65-year-old retiree, and she relies on her dividend income to supplement Social Security. And she has dividend paying stocks that increase their payout each year, helping her to keep up with inflation and maintain her overall lifestyle. It's not that any investment vehicle is just for one person. It's whether or not it makes sense to help us accomplish our goals. And depending on what our goals are, the same instrument can be adjusted in a way that helps us to be able to achieve that goal. And myth number 5 is, can dividend investing protect against market volatility? And the short answer is no. When we're investing, whatever we're investing in, there is a level of risk that we're dealing with, whether it's interest rate risk, whether it's longevity risk or market risk, financial risk, business risk. There's risk in all of these different investments. That's part of the reason that they give us the ability to earn and grow our money. So there isn't really this idea that I can avoid market volatility altogether. What we often are able to do is when the market starts declining. So let's look at the 2020 during COVID. We saw companies like McDonald's and Coca-Cola continue to pay their dividends out, but their price declined. The value of their stocks did decline. The difference is maybe I was able to keep from selling my stock because they continued to pay a dividend. And if we continue paying a dividend out, then I'm able to receive my income if I'm retired. And now I'm able to wait out this market volatility, this market storm. Also, most of the time we're choosing dividend stocks, especially if we're building a retirement portfolio. Oftentimes we're focusing on blue chip companies, a very fancy way of saying very stable companies that probably aren't going anywhere, that they might have a price decline, but because I have a dividend tied to them, I was able to leave that investment. I did not have to sell that stock and allow it to grow and recover. So that is a way that it can help you manage market volatility. But the idea that you don't have market volatility, that's not true. You will have your stocks go down with everyone else's stocks. The difference is I'm investing in a company, ideally, that I'm confident is going to make it through whatever that storm is. And once it does, it'll rebound and it'll be better off for it. And if I have that level of confidence in my investment approach, you get to do this cool thing of buying the stocks when they're on sale. That if I was to see a sale at a grocery store or the mall or online on Amazon or Black Friday, that you and I would be excited to go out there and buy certain items because we know that the value of that item doesn't change because the price of that item changed. But when it comes to investing, because a lot of us are gambling and not investing, we don't actually have that level of confidence that the value of that stock maintains or even grows when the price of the stock declines. But if we do have an investment strategy and an approach that we can maintain, well, now when the price goes down, I'm as excited as Black Friday. I know that this company's value is still there and they are selling it at a lower price for me. And the way I often think about this is every economic climate, there are going to be people who win and there are going to be people who lose. That there is not a guaranteed rule that everybody wins or a guaranteed rule that everybody loses. And so what we're saying is in a time of recession, there are people who are going to make the most money they've ever made in their entire life. There are going to be people who lose everything. In times of economic growth, there are going to be companies who file for bankruptcy and lose everything. And there are going to be companies who literally change an entire market and become a household name overnight. That the climate, the economic conditions that we're dealing with rarely decide what the results that we have are. You and I decide the results that we have. Our beliefs, our understanding, our knowledge, our effort will decide the results that we get in a variety of economic climates. So if we built a portfolio that is made to perform well during times of economic recession, then we'll be okay. If we've considered a lot of these future events in our investment strategy, then we're going to be comfortable taking advantage of the opportunities as they present themselves because they will 100% present themselves. But with that said, I don't think you should be one of those people that's like, oh, I missed out on that opportunity. I have to do something next time it happens. I would say no. I think Warren Buffett described it best. He said it's like being a baseball player, you have an unlimited number of pitches. That is not a 3 strikes and you're out, that you can watch a bunch of pitches go by and only swing at your absolute perfect pitch. And that's what investing is. There are going to be different price changes all the time. The stock market is going to give you opportunities on a regular basis. And if you miss one, I promise you there'll be another one. That the idea that, oh, I missed out on Amazon or Meta and then it will never happen again. And then Nvidia comes and you're like, oh, I missed out on Nvidia and that'll never happen again. But the reality is it always happens and it happens on a regular basis. So I would plan for the next event. And then when it happens, I'm ready for it. I would not allow myself to get a case of FOMO and jump on something at the very highest price. And then it's going to go down and then I end up selling low. which you and I both know is not a sustainable approach to investing. So as you can see, dividend investing is a powerful wealth building strategy, but understanding these myths will help investors make informed decisions. Whether you're just starting or looking for passive income, focusing on quality companies and long-term growth is key. I hope you've enjoyed our dividend investing series. If you missed any of them, I will put a link and I'll create a playlist so you can watch all 5 of the videos in the series. If you have any additional questions, go ahead and leave them in the comments. Of course, if you enjoyed the video, go ahead and like and subscribe so you continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.